Gold just closed out its best week since January, not since last month. Since January, the same month it set its all-time record high, it climbed more than 7% in 5 trading days, touching a 2-month high, above $4,350 an ounce. Silver moved even harder, surging 4% in a single session to a 6-week high, dragging the ratio between the two metals down in a way that specifically rewards anyone who has been quietly buying silver while gold got most of the attention. And underneath the number that triggered all of this sits a second, quieter statistic that is genuinely more alarming than the headline that made the news. I am going to walk you through exactly what happened this week, why silver moved even harder than gold, and the number hiding underneath Friday's jobs report that almost nobody reported clearly. Stay with me, because this is one of those weeks where understanding the mechanism matters more than just watching the price. Here's the twist, and I am giving it to you immediately instead of making you wait. Friday's headline said the economy lost 23,000 jobs in July. That number alone was enough to send gold and silver surging within hours. But 23,000 is not actually the real story. Once you account for how heavily May and June got revised downward, the trailing 12-month average of job creation has now collapsed to somewhere around 34,000 jobs a month, not 23,000. For one bad month, 34,000 as the new normal, averaged across an entire year. That is not a single disappointing report. That is confirmation that the labor market has been running far weaker than the headlines told you for the better part of a year, and the market did not just react to one Friday morning. It reacted to finally seeing the real trend that had been hiding underneath a string of numbers that looked fine in real time and kept getting quietly revised down after the fact. Before I go further, I want to know who is with me right now. Tell me in the comments where in the world you are watching from, and tell me honestly whether you were holding physical gold or silver before this week's surge, or whether you are watching from the sidelines wondering if you missed it. I read these, and I promise you the mix of answers under a video like this always tells its own story about who was positioned before the move and who is only paying attention now that it already happened. Let me walk through exactly what moved and why, because the mechanics here matter. Friday's jobs report showed non-farm payrolls falling by 23,000 inches July, a stunning miss against an expected gain of 80,000, the first outright monthly decline in months. The reaction was immediate. The dollar fell to a 2-week low, Treasury yields dropped, and traders rushed to unwind bets on a Federal Reserve rate hike that just over a week earlier had looked like a real possibility after 3 Fed officials publicly pushed for tighter policy. Weak labor data pulls hard in the opposite direction from that hawkish push, because raising rates into an economy that is now shedding jobs is a much harder case to make. And the market repriced that reality within minutes of the report landing. Gold, which had already been building momentum through the week on falling energy prices and softening labor signals, broke through to its best level in 2 months. Silver did something even more interesting. It surged 4% in a single session, compressing the gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, down to around 67 from close to 69 just a week earlier. If you are finding this useful already, take a moment to like this video and subscribe, because the next part explains why that ratio number matters so much to anyone who actually holds physical metal. And it is a detail almost nobody outside serious stackers ever pays attention to. Here is why the gold to silver ratio deserves your attention. For most of history, that ratio has swung within a range. And when it sits on the higher end, it means silver is historically cheap relative to gold, undervalued by the market's own internal math. When silver suddenly outperforms gold, the way it did this week, compressing that ratio lower in a matter of days, it is often a sign that the broader move is shifting from being purely a safe haven story into something with real speculative and industrial momentum behind it, because silver tends to lag gold at the start of a move and then catch up hard once conviction builds. Anyone who has been accumulating silver over recent months, while the ratio sat closer to 70, just watched their relative position improve meaningfully in a single week, simply by holding the metal that was, by historical standards, the more discounted one. Now, let me return to the deeper number, because it is the piece that explains why this move has real substance behind it, rather than being a single overreaction to one data point. A trailing 12-month average of 34,000 jobs a month is a genuinely weak number by historical standards, well below the pace typically needed to keep up with population growth, let alone signal a healthy expanding economy, and it did not appear out of nowhere on Friday. It built quietly month after month through a pattern of initial reports that looked merely soft in real time, followed by revisions that consistently pushed the picture lower after the fact. Friday's outright decline was not an isolated shock. It was the moment the cumulative weight of those quiet revisions finally became impossible to describe as anything other than what it actually was. There is a historical pattern worth knowing here, because gold's sharpest weekly moves throughout its history rarely happen in isolation. They tend to cluster around the exact moment a market finally accepts a piece of reality it had been quietly resisting for months. Gold's own January record this year followed a stretch of building central bank buying and mounting fiscal concern that the broader market had been slow to fully price in, right up until it suddenly did. This week looks like a smaller version of that same pattern, a market that had spent months absorbing incrementally softer labor data without fully repricing around it. Finally doing so all at once, the moment the trend became undeniable rather than debatable. That does not mean every sharp weekly move turns into a lasting trend. It means that when a move this size follows a slow, quiet buildup, rather than arriving out of nowhere, it tends to carry more real weight than a move driven purely by a single surprising headline with nothing underneath it. Let me make this real with two people, because none of this matters until you see how it lands in an actual life. Neither is real, but both are the kind of person you might recognize. The first I will call Wendell, 71, who watched gold's January record and the pullback that followed and concluded the moment had passed, that he had missed his window, and the smart move now was to wait for the next dip before adding anything more. He watched this week's 7% rally from the sidelines, the same rally that pushed gold to its best level since that very January peak, and found himself right back where he started, wondering whether to chase a move that had already happened or wait once again for a pullback that may or may not come at a price as good as the one he already passed on. The second person I will call Constance, 69, and she took a different approach months ago. Rather than trying to perfectly time a bottom, she made small, regular additions to her physical holdings through the pullback, paying more attention to the gold to silver ratio than to the day-to-day price alone, adding a bit more silver specifically when that ratio sat on the higher end of its recent range. When this week's move arrived, she was not scrambling to decide whether to chase it. She was simply watching a position she had already built continue to work, with her silver holdings benefiting disproportionately from exactly the ratio compression this week produced. The difference between them was never how much money either one had. It was that one of them was waiting for a perfect moment that markets rarely actually offer. And one of them had already built a position steadily enough that a week like this one simply worked in her favor without requiring a single perfectly timed decision. Now, why do so many careful, intelligent people end up like Wendell, waiting for a better entry point that keeps receding the longer they wait? There is a well-documented reason, a bias toward regret avoidance, the fear of buying right before a drop weighing more heavily on the mind than the quieter, less dramatic cost of simply missing a rally entirely. That asymmetry feels rational in the moment, but it quietly leads to a pattern of waiting through entire multi-month moves, watching from the sidelines, always hoping the next dip will be the perfect one, right up until a week like this one arrives and the price has already moved well past where it sat during all that waiting. Now let me be careful and honest with you, because I will not insult you with fear. And this exact subject draws people who want to frighten or excite you into a rushed decision. A single strong week does not guarantee the rally continues in a straight line, and gold and silver remain genuinely volatile, capable of giving back a real portion of a fast move, like this one, just as quickly as it arrived. It is entirely possible. Next month's jobs data comes in stronger and complicates this exact narrative. The weak labor trend I described is real and well documented in the data, but it does not guarantee any specific outcome for the price of either metal on any specific timeline. And anyone telling you this week's move guarantees what happens next is overselling you a certainty the market has never actually offered anyone. What I am giving you is not a promise that this rally continues. It is an honest explanation of what actually happened this week and why. So you can make your own decision with a clear understanding of the mechanism rather than reacting only to a headline percentage. After the fact, so let us pull this together and go back to where we started. Gold just posted its best week since January, its own record-setting month, climbing more than 7% to a 2-month high above $4,350. Silver surged even harder, up 4% in a single session to a 6-week high, compressing the gold to silver ratio in a move that specifically rewarded anyone holding silver through the recent pullback. The trigger was Friday's jobs report, but the real story underneath it is a trailing 12-month average of job creation that has quietly collapsed to around 34,000 a month, a trend that had been building through months of downward revisions long before Friday's headline made it undeniable. And the difference between the people who benefited from this week's move and the people still watching from the sidelines comes down to one thing: whether you were already positioned through the pullback or whether you were still waiting for a perfect entry that markets this week once again did not wait around to offer. Here is what I want you to carry away from this, stated as plainly as I know how. This is not a call to chase this week's rally with a rush decision, and it is not a call to abandon patience, because balance and discipline matter, especially with retirement money. It is a call to understand that waiting indefinitely for a perfect entry point carries a real cost of its own, the cost of missing weeks exactly like this one, and that a steady, deliberate approach, paying attention to signals like the gold to silver ratio rather than only the daily price, tends to serve people better over time than trying to perfectly time every single move. Whether adding to gold or silver makes sense for you right now depends entirely on your own circumstances, your own timeline, and your own comfort with volatility. And I am not here to tell you the number. I am here to make sure you understand exactly what happened this week and why. So the next move, like it does not catch you the way this one caught anyone still waiting on the sidelines. Do not let anyone use this week's rally to rush you into a costly decision today, because there will be people trying, and they get louder every time a move like this happens. And do not dismiss it either. Telling yourself one strong week could not possibly reflect anything real, because you just watched a jobs report reveal a full year of hidden weakness in a single Friday morning. Those are two different mistakes, and the sensible path sits calmly between them. None of this is financial advice. Every figure I have referenced, the weekly percentage gains, the gold and silver price levels, the gold to silver ratio, the trailing 12-month average of job creation, comes directly from this week's market reporting and the Bureau of Labor Statistics' own published data, so you can verify every word of it yourself rather than take mine. I opened by telling you that gold just had its best week since January, and that a number hiding underneath the headline that caused it is worse than most people realize. Now you understand exactly why. 23,000 jobs lost in a single month, sitting on top of a trailing average that has quietly fallen to just 34,000 a month, revealed all at once in a week that rewarded anyone already positioned and left everyone else watching from the sidelines. So let me leave you with the question underneath all of it. The next time a week like this one arrives, and based on what is building underneath the surface right now, it likely will again. Will you already be positioned the way Constance was, Or will you be exactly where Wendell still is, waiting for a perfect moment that the market, once again, will not wait around to offer you?